Hey there, welcome back to my channel, it's me the Mind Injector. In this video we're diving deep into the electrifying world of Mullen Automotive. This stock has been in full focus, and it's been causing quite a stir in the market lately. Mullen has taken center stage with an update on its lawsuit against broker-dealers TD Ameritrade, Charles Schwab, National Finance Services and more. But what's this lawsuit all about, and why should you be interested? Well, sit tight because we're about to explore the shocking details and what this means for Mullen stock. Mullen Automotive isn't one to back down from a fight, especially when they suspect market manipulation. They've alleged that broker-dealers engaged in a market manipulation scheme that increased the supply of Mullen stock available for short selling. Since they made this lawsuit announcement on August 29th, Mullen stock has taken a nosedive, plummeting by a staggering 60%. But there's been a significant development in the case. On October 19, Judge Annalisa Torres let down the law. She provided two crucial deadlines for all parties involved. Mullen, the plaintiff, has until November 30 to file its amended complaint. Then, by December 15, both parties need to jointly file their case management plan. So, what's at stake here? Well, the case management plan will include a motion to dismiss by a specific date. But here's the kicker. If things go Mullen's way, the discovery process kicks off soon after. To bolster their position, Mullen had previously retained the services of law firms Christian Adler and Warsaw Burstein. The goal is to expose any wrongdoing by the defendants and hold them accountable for every dollar wrongly extracted from Mullen and its shareholders, be it through settlement or judgment. What Mullen is alleging is quite intriguing. They are saying that the broker-dealers sold fictitious shares of Mullen stock before Mullen even had the chance to issue its own shares. To make matters worse, they allegedly removed shares from customers' accounts. Why? To lend them to other investors or cover their own short positions before the issuance of new shares. These actions spanned between May 4 and August 25 and involved over 34 million fictitious and/or shareholder-owned Mullen shares. This mess forced Mullen to do not one, but two reverse splits of its shares. Last week, Mullen dropped a bombshell by proposing yet another reverse split. This time, the ratio will be between 1:2 and 1:100. This decision will be put to a vote at the upcoming special meeting of stockholders scheduled for December 15. What's crucial here is that Mullen won't enact this reverse split unless its shares can't organically reach $1. In other words, if they can do it the old-fashioned way, they will. But it's like a game of financial chess because it's not just about reverse splits, it's about playing by Nasdaq's rules. Let's talk about this because the situation gets even more interesting. Nasdaq has a requirement that a company's shares must maintain a minimum bid price of at least $1 to stay listed. This is where things get tricky. If Mullen carries out another reverse split in a ratio of 1:2 or more, it may become ineligible for a compliance period to regain that $1 mark. However, here's the catch. If Mullen stock stays above $1 for at least 10 consecutive business days following a potential reverse split, they could still meet Nasdaq's requirement. So, what's the bottom line here? Mullen has a lot at stake in this move. Their ability to continue trading on Nasdaq and the confidence it gives to investors could be significantly affected by the outcome of these votes and actions. Mullen Automotive has had a roller coaster year, no doubt about that. Their stock price has swung dramatically, from as low as 10 cents to as high as $5. For some speculators, this volatility has been like striking gold, but for the majority of investors, the story isn't so shiny. The question looms. Should you even consider investing in this stock? Well, here's where we need to separate potential from reality. You see, Mullen's fans highlight its potential. The company has big plans to launch several electric vehicles in the next 2 to 3 years. That's exciting, no doubt. But there's a crucial catch. To realize this potential, Mullen needs impeccable execution. And remember, their team doesn't have extensive experience in the auto industry. Furthermore, they have to compete with established EV brands. It's like the smartphone market. Apple's iPhones may be a bit pricey, but they dominate because they've earned people's trust. Androids might be cheaper, but they get less love. There's another elephant in the room, and it's about how Mullen has been raising capital. Their approach of continuous stock offerings has resulted in severe shareholder dilution. This means that every time they issue new shares, your piece of the pie gets smaller. So even if Mullen does succeed, your gains might be a drop in the ocean. Mullen seems to put shareholders last in this equation. They are shifting a significant portion of business risk and capital burden onto common shareholders. This, in my view, makes Mullen stock uninvestable for most. Before we get into the exciting details, let me introduce you to Mumu Financial. If you open a brokerage account with Mumu and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So sign up now using the link in the description and get those free stocks. Now let's get back to the video. Let's take a peek at the financials because they can tell a sobering story. Mullen is a pre-revenue company, so no surprise there. But if we dive deeper, we see that they have minimal revenue. In fact, it's in the thousands. Yet, they've spent over $229 million on operating expenses over time. And last year, they burned through a mind-boggling $740 million. Simply put, they have hardly any gross profit. Their colossal overhead costs have led to massive losses and negative cash flow quarter after quarter. To keep the ship afloat, they need to keep issuing new shares, which is a giant red flag for investors. So, what's the verdict here? Mullen's situation blends the risks of an early-stage, pre-revenue biotech company with none of the potential rewards. Unless they pull off a miraculous feat that surpasses all expectations, shareholders are staring down the barrel of ongoing value destruction. In a nutshell, Mullen Automotive, despite its potential and intriguing plans, is, in my opinion, far too risky to justify buying shares now. It's like entering a turbulent sea without a life jacket. The milestones required for this stock to become even close to investable are a long way off. Sure, you'll hear plenty of speculation about potential deals and short squeezes, and that will likely continue causing massive price swings. But here's my advice. If you're a prudent investor, you're better off keeping your distance from Mullen stock for now. Let's keep an eye on Mullen's progress over the next 6 to 12 months. If they can hit those milestones, then maybe, just maybe, it'll be time to reconsider. Until then, this stock is a wild ride that most investors should steer clear of. This is it for this video, guys. Thanks for watching and please make sure to subscribe, like, and leave a comment down below.